The advantages the advantages are that general partners have additional capital. The limited partners do have limited liability, so you can take out a liability policy in the name of the partnership. You can allocate your incomes and your losses. It does avoid the double tax because you're only still taxed as an individual in a personal income as a personal income tax, and it has a finite existence because you can assign your partnership upon the death or incapacity of one of the members. But the disadvantages are that the initial cost is high to set up. The limited partners have no control, and the partnership profits taxed to income as the partners. And you must comply with the state and federal securities laws. So a limited partnership can have more than two people. Okay. So even though it's a partnership, there may be more than just two people involved in that limited partnership or LLP. The next one is the limited liability company or LLC. This probably resonates with most of you. It is very, very common. I am going to guesstimate that probably 97, 98% of our clients, when they're organizing their business, organize as a limited liability company. The advantages are that there are limited liability limits on the management participation. So you as an owner are not, your personal assets are not as exposed individually. There's flexible ownership and capital structure. As a matter of fact, an LLC can have up to 35 members, and you're still only taxed one time. And that is according to the profit of the business. And you are you're taxed at your personal income tax rate. So whatever tax bracket you're in, assuming that this additional income doesn't put you in a new tax bracket, your taxes will be just the same as they are if you were receiving a W-2. And if you have multiple members, say 10 members or so, or well, even 2 members, for instance, then the tax benefits are split also among the members. But obviously, one of the disadvantages is you must have approval of all members before your management duties are transferred. So if there's 2 of you in the LLC, you both have to agree before the management duties are transferred, whether that's within the members of the LLC or to some outside third party. And obviously, the more members you get, the more complicated it can get to get everyone in agreement on that. So if there were, 20 members, you would then obviously need to have the majority in order to transfer those duties. All of these responsibilities, the percentages of ownership are all spelled out in an agreement as you enter into your LLC. So we're all on board today. We all see things the same way. We're all in agreement. So we write up that operating agreement so that everyone is in agreement, can sign off on it, and we know where it stands. Let's say 6, 8, 10 months, couple years from now, something happens within your organization, and maybe those people or that person, and you no longer see eye to eye. Well, the good thing is by having an operating agreement, you can go back and say, hey, look, this is what we agreed on, and this is what we're going to do. And heaven forbid, if it should ever get to a court of law, that operating agreement will stand and those rules will be followed. Obviously, they can be amended, they can be altered at any time with the approval of the membership, but at least you have some structure to keep you along the same path and everybody on the same page. The next level would be the C corporation. And the first thing that I'm going to point out that you see is the limited liability of the shareholders. Shareholders is the key. Typically, this is for larger organizations, those who would perhaps exceed the 35 member limit set by the LLC, and they want to have more people involved, or maybe they've just got private investors who really have nothing to do with the business other than making their financial investment in it. And so therefore, you would want to consider a C corporation. And again, you'll notice it says flexibility of financing through outside investors. It gives you a little more opportunity than the smaller LLC does. But it also comes with some disadvantages that there are high costs to not only set it up, but also to maintain it. There are annual reporting requirements. So in an LLC, you don't have to report to any government level with any bylaws, organizational minutes, or anything. You simply have to report taxes to both the federal level and the state level. But with the C Corp, you are required to hold a minimum of an annual board meeting. You do have to have board members. You also have to send in those minutes to both the state and the Internal Revenue Service. So you're also double taxed. So the corporation will pay taxes because it made a profit, as well all of the members of and shareholders of the corporation. So that gets obviously a little more complicated. One of the reasons that there's higher costs involved is it generally does take an attorney, and you've got a lot of reporting requirements that an attorney will generally handle for the corporation. And then the S Corp is very similar to the C Corp. However, that is limited to one class of stock. Only individuals can be shareholders, not companies or businesses. Other than that, the tax consequences remain the same as they do for a C Corp. But you need to be a C Corp before you can become an S Corp. And typically what we see in the S Corps are those are publicly shared stocks. Okay, so like you might be see yourself on the stock market when you grow to that level. Okay, but again, for all intents and purposes, most of our small businesses will utilize the limited liability corporation. That's a good
Kathy,
one.
I have a question for you.
Yes, ma'am.
Do you have to be a C Corp for a certain period of time before you can go into an S Corp?
Yes, there is a minimum time on it. Boy, it's been a while since I researched that, but the last that I recall, there was a minimum of 24 months to be a C Corp before you can move to an S Corp.
Okay,
And
thank
basically
you.
that's to monitor your actions as a business. Yeah.
Great, thank you.
Yep, you're welcome. Thanks for the question. Okay. So again, with an LLC, you are able to set up the name of the business and leave your social security numbers out of it. Okay, so you get this business name, and that's the new representation for the business. So the first thing we do is we check our name availability with the Ohio Secretary of State. So let me say that when you reserve your name with the Ohio Secretary of State, it means that no one else in the state of Ohio can register a business with that or a very similar name. Obviously, they want to keep everybody separate and know who is who doing business. That does not mean, however, that a domain name or someone out in another state is not using that same exact name. Please be aware that it's only reserved in the state of where you set up your LLC. Okay. So I ran into a situation yesterday where somebody's got their name registered with the Ohio Secretary of State, but when they went to get that domain name as a .com, it was already taken. And they were calling with concerns about that and how did that happen? So again, I just want to remind you that it's only the name only. It can be anything else when you start talking about online and out in cyberspace or a different state for that matter. So once you know that that name that you want to use is available, then we file your original articles with the Ohio Secretary of State office. That is simply a form. It's a simple process to do. It certainly isn't rocket science, but we here at the Small Business Development Center are happy to help you through those steps. It can be a little confusing because it's brand new for you. And fortunately for us, we've been doing it for 16 years. And so we're very familiar with it and we can walk you through that. That does come with a $99 filing fee payable to the state of Ohio. But once again, the services of the Small Business Development Center, there's no charge for us to assist you with that. And once we know that name is good, we will jump over to the Internal Revenue site and we will apply for your employer identification number. And this is very, very important and a real advantage to having an LLC, because that employer identification number, often referred to as an EIN, will then become the identification number, or the social security number, if you will, for the business, as opposed to using your personal social security number like you would in a sole proprietorship. Okay. So then, as I indicated, we'd have that operating agreement. We also have a template for you, which really helps. It at least gives you an idea of what should be included in that. And that operating agreement is not filed anywhere. Oftentimes, people will file it with their attorney to make sure that, again, it's someone of a third party knows where it is. But when I say it's not filed anywhere, it does not have to be filed with the state of Ohio, nor the federal government. It simply is between you and the other members. Excuse me. Then many banks are now requiring a resolution to open a bank account if you're an LLC. And again, we provide the template for you. And basically what that says is, yes, we have legally formed an LLC, and as a member of the LLC, we have the authority to do X, Y, and Z regarding our bank account. And so that's really helpful. And those are inclusive of anything that could be done through a bank. And then another real advantage is that you're able to purchase liability insurance in the name of the company. So whereas a sole proprietor, your personal assets, your personal liability insurance is responsible for the business, we now have liability insurance in the name of our business. And so in the event of a lawsuit, that insurance would kick in and cover any damages before our personal insurance or our personal assets would be brought into the lawsuit. So that's a big plus. And people are like, oh, insurance. I know we have a tendency to flip out a little bit when we hear that because we think of cost. But let me assure you, it is a relatively small part of your business expenses and well worth it should you ever, heaven forbid, run into a lawsuit. And the rate is actually based on the level of liability for your particular company. Obviously, if you're washing windows on the 23rd floor of an office building, your liability is going to be much more than if you're, selling from your home some sort of a product. Obviously, if you have a brick and mortar store, you do have a little more liability with people moving in and out. However, there's always that one freak thing that happens that, that sock monkey you made, the button came off and some small child, unfortunately, ingested it and there were complications. So, that's why it's important to discuss that with your insurance agent and get that liability insurance in the name of the business. If you're going to form a corporation, it does become a little more complicated. So you have the filing of your articles of incorporation. You have to adopt the bylaws, hold organizational meetings with the board of directors, issuing stock, receiving capital from investors. So again, I would just encourage you to, think about which organizational structure fits you the best, and we're happy to discuss that with you. As we discussed previous weeks, there are definitely government regulations which will impact your business. And so it's very important to know in your business sector, what will those be? Just general business taxations are personal income tax. Is there a business income tax? And keep in mind that I said if it's an LLC, you're only taxed once, okay? So the business income tax does not exist for an LLC or a sole proprietor. Obviously, there's sales tax, and the sales tax is the way that the state actually makes money to distribute to their townships and counties and all of your local entities. And so the sales tax is actually your privilege for doing business in the state of Ohio. You get to help the governor keep our state in good shape. So the sales tax rate is charged depending on which county you're in, because counties do have the authority to impose more than the state sales tax is. And every county that I know does have a higher rate than what the state flat rate is. But basically, it's your privilege to collect that sales tax and submit it to the government. And while that's a privilege, if you fail to do that, believe me, it comes with very hefty late fees, fines, and ultimately can result in jail time, because that money is ultimately not yours. Rather, it's a pass through from your customer to the governor. And then, of course, if you own property, there are property taxes involved in your building and business license fees. Business licenses, other than, again, filing your articles of organization, if you're in doing business that needs to charge sales tax, you will need a vendor's license. And other than that, there really are no specific business fees in the state of Ohio, which does differ in some neighboring states. So the cost, again, is relatively inexpensive to get set up. $99 to register your articles with the state of Ohio. A vendor's license is like $25. So we're fortunate in that regard, and obviously a sign that we do encourage small business growth in the state of Ohio. Then we have to look at employee regulations. So if you have employees, it does become a whole different ballgame. There are certain requirements that you need to do. For instance, your payroll tax to be withheld. So if you currently or in the past have gotten a W-2, you obviously know that there was federal income tax withheld from your paycheck. There was also Medicare tax and Social Security if you did not work for a public entity. And so all of those things need to be withheld by the employer, which in your case would be you, from any employee payroll that you issue. Then there becomes the question of an employee versus an independent contractor. Obviously, because of these additional fees with your payroll tax and your withholding, oftentimes small businesses want to say, well, these people are independent contractors for me. However, I will just caution you that there is a very, very fine line and some very well-written and restrictive regulations put in place by the Internal Revenue Service as to what constitutes an employee versus an independent contractor. That's become a real hot spot right now. And so for the IRS. And so they are watching that very, very closely. And again, I will tell you that if you are doing it incorrectly, the fines and the penalties are something that you really don't even want to have to deal with, much less all of the red tape and the problems that it creates for your business in doing business with wholesalers. So if you have any question, any doubt about that, I've got a handout, or you can go to irs.gov and it will clearly, that's where the handout came from. It will clearly tell you what the difference is. In a nutshell, if someone is doing work with you or your company and you oversee that work, supply tools for that work, or tell them when to be there and when to have the job done, they are clearly an employee. If you just simply say, hey, we need the lawn mowed at 411 South Main Street, and they take their lawnmower over and they go do it at whenever time is convenient for them, they report back to you that 411 Main Street's been mowed, then that is an independent contractor. Obviously, there are hour and wage regulations set by the federal government and the state government. We know that there's a federal minimum wage, there's a state minimum wage, there's regulations regarding teenage workers, youth workers, to the numbers of hours, what they can and cannot do as a minor. So we have to look at all those things, and as well as OSHA. And you'd be surprised how many times OSHA gets involved in small businesses, because we need to follow their safety compliance to make sure that our employees are not in jeopardy. And then depending on what line of business you're in, you may be looking at some consumer protection regulations regarding warranties or the Uniform Consumer Credit Code in filing items as liens or holds against some of your employees and or your customers. So that was a lot on this page. I would entertain any questions anyone has regarding that. All right, hearing none, then it's just important to know which regulations actually impact your business, okay? So while I said that licensing is fairly easy and, it's simply not a business license, but rather vendor's license and your articles of organization, obviously, if you're in a professional field, there may be particular license that apply to you. And so healthcare, cosmetology, barber, there's lots of different areas. And so we want to be cognizant of that. And then there's zoning regulations. We discussed that before. If you're doing an at-home business, is your business zoned properly? Or if you're in a commercial area, are you able to maybe, make widgets in that commercial building? So we have to worry about that. What are the bankruptcy regulations? Hopefully we don't get to that point, but unfortunately we do. And they're really not as easy as everyone has the misnomer that they are. And it certainly is something we want to avoid at all costs if we can. And so there's other environmental and other regulations specific to your business, which again, you can Google online, look for the agency that would prescribe those to you, and certainly call us if you have any questions about that. So that leads us to a very, very important topic. And I certainly don't want to leave you out of this about accounting for your business, because accounting for your business, the numbers, while most of us go, yuck, that is my least favorite part of business, it is absolutely, obviously, the most important part of your business as well. It's going to allow you to make your business grow. It's going to set the pace at what you can, at what pace you can grow your business and how you can do it most successfully and worry-free. And one of the things is actually just keeping good records. And that doesn't mean it has to be anything complicated, as we'll discuss here in the next few minutes. So in accounting systems, there are basically two methods that you can use. One is an accrual method, and one is a cash accounting method. In the accrual method, you record everything when the work is done. You do your billing when the work is done. You record your revenue and your expenses at that time. There's a little more effort tracking what has accrued and what needs to be reported than there is in the cash method. So in other words, in an accrual method, you typically will have terms with both with your vendors and with your customers. So as you can see, there's more tracking. When does this bill become due? How can I get the money from my customer to make sure I have it in time to pay my vendor? There's more issued. The majority of our businesses do use the cash method. Much simpler, much less bookkeeping. So generally, cash is received. You record the revenue and the expenses at this time. So through the cash register, right? And then it's kept using a checkbook register of some sort, whether it's electronic or, again, paper and pencil, like we saw in at the beginning. And those are based on historic costs. So when you use a cash system, you're looking at the historic cost principle. Your financial statements are prepared using what has happened in the past. So amounts are recorded at the time of the transaction. They're not adjusted for the fair market value. It happened on this day and time, and that's exactly what happened at that time. And it's important that you keep good financial statements. This is important not only if you're going to be looking for investors or a business loan, but it also tells you as the business owner at any point in time where your business stands. So you know if you're operating at a profit or at a loss, how much that profit or loss is, and you can make adjustments accordingly to change the outcome of those finances if you are not comfortable with them or reaching the goals that you have established. So financial statements include an income statement, a balance statement, a statement of the owner's equity, and a personal financial statement. Those are basically the four individual statements that, when compiled, you'll hear financial statements. So, again, a bank might say to you, well, we need your financial statements. You know what those are. That means an income statement, balance statement, owner's equity statement, and personal financial statement. So, what does each of those statements tell us? Well, an income statement summarizes the income activities over a specific operating period of time. So we can pick whatever period of time we want to look at. It might be an income statement for the week, it could be for the month, maybe it's for the quarter, semi annually, or annually. Okay. But we can pick whatever period we want to know what happened through that period of time and see what our actual income or net loss for that period was. So, in other words, it will list all of your income and all of your expenses for the period of time that you specify. And you can see at that moment if you operated at a net income or a net loss for the specific period. Okay. Again, if you have questions at any time, jump in here because I want to be sure that you understand this. It's very integral to operating your business. Okay. So the second part of that, there we go, is the balance sheet. So a balance sheet gives a picture of your business's financial condition on a particular day. So while the income statement was a period of time, the balance sheet looks at today. So it's looking at April 13th, 2021. And we can say, what is our balance for today's conditions? So we look at the assets. The assets are what the business owns. And then we look at the liabilities. What does the business owe? What is it not yet paid for? And then your owner's equity becomes the difference between the assets and the liabilities. Okay, so it's very simple to figure out. What does the business own? What does the business owe? And so what is that equity? And hopefully we're going to find that in a positive position, but it doesn't always happen that way. And so if we find that it's not in a positive position, we certainly want to look at what we can do differently so that we can get it in that positive position. Okay. The next statement involved in the financial sheets is the cash flow projection statement. This is very, very critical in helping plan what your business is going to do for the year. So a cash flow projection sheet is based on budgets for your anticipated expenses. Of course, we can't always know day to day what those might be. For instance, there could be a plumbing problem. It's just like when you're operating your home, right? There could be something different every day. It's like, well, here we go again. But this is a thought process looking at our best estimates as to what is coming up down the pike for us. And it's based on budgets for your anticipated sales, for your anticipated revenues. If you have something that is seasonal related, and here we are moving into spring, maybe you're a greenhouse and this is going to be your busy time of the year. Well, that cash flow projection for the month of May is going to look a lot different than it probably did in the month of December for you. Once we know our anticipated expenses and our anticipated revenues, we project how the cash flows in and out using those budgets. So what day is that electric bill going to be due? And what day are my account receivables coming in? Am I going to have enough money to meet the date that that bill is due? It's a crucial tool to be able to effectively plan for your management of cash. You don't want to be cut short. You don't want to be paying late fees. You can't afford to have your utilities disconnected. So, a cash flow projection statement is basically saying this is what's going to be coming in, this is what's going to be coming out. And we're going to go much more in depth in that in next week's class as we start to look at uh, actually building them for our particular individual businesses, which is a part of your written business plans that you're working on. And then the final part of your financial statements are your personal financial sheets. And so that's using market value information. Again, perhaps the value of your home, the value of your automobile, those kinds of things. And it simply changes the terminology from owner's equity that we saw back on the previous balance sheet statement, right, to net worth. So it's taking your personal assets minus your personal liabilities, and it's making that your net worth. Again, if you're going to borrow any money, the bank is definitely going to want to know what your net worth is. And so that's an important first step with that regard. You can use an outside accountant to help you prepare your financial statements, or you can use a software program on the computer, or you can simply do it on your own. And we're going to discuss those ways and what makes a good accounting system here in just a few minutes. One of the health checkups for your business is actually using a liquid ratio formula. Okay. So what does liquidity mean? It is the business's short-term ability to pay its current and unexpected debts. So this is going to be a number that is very important when you're saying, how valuable is my business? Okay. It's going to be working capital. So your current assets minus your current liabilities means that is the money that you're able to reinvest, whether you're buying more product or you're expanding your business or workforce. That is money, cash that you have that you can reinvest back into your business. So current assets divided by current liabilities is a preferred position to be in. So in other words, we want twice as many assets as we do liabilities. That is a very comfortable current ratio for where you sit right now. And remember, when we talked about our balance sheet, we can find out at any given time what our assets are and what our liabilities are. And there's also a quick ratio. So that is basically taking your cash plus any marketable securities that you have that are tied up elsewhere that aren't as easily accessible as your cash is, plus the receivables that are on the book, money that is expected to be coming in, and you divide that by your current liabilities. And that preferred ratio today is 1-to-1. So they want as much basically access to assets as there are liabilities. And so to find out what your debt to equity ratio is, which again is a very, very common question by lenders, you actually take your total debt and you divide it by your total equity. And that's going to give you your debt to equity ratio. And banks have a very specific graph that they follow of what they're permitted, the parameters that you need to meet. And so if you can figure these out on your own, you'll have a pretty good idea and be prepared walking into a bank as to what they will expect from you. And then your debt to total asset ratio is simply, what is my total debt? What do I owe? Divided by your total assets. What do I own? And that will tell you what your debt to asset ratio is, which is also another factor. And it also, there are industry standards, again, about what is the normal for whatever type of business you're in. And you can find those online. And there's also some other research companies. And again, we have access to those. Glad to lead you through those. But what is the normal? So obviously, it's going to look a lot different if you're, let's say, an automobile salesman who's got lots of inventory tied up on their lot, as to whether you're selling costume jewelry. Okay. You may have as many pieces of costume jewelry, but because the cost structure is totally different, it should look way different than that car dealership should. Okay. And so when we look at the industry standards, it's going to look a lot different for that jewelry um, accessory sales than it is for the car automobile industry. So I said there's lots of ways to keep that accounting system, okay? I don't want you to be overwhelmed. So let's talk about what makes a good accounting system. All we expect from our accounting system is that it's going to accumulate the information that we need to make good decisions about our business, okay? So all of the things we talked about previously, all we want it to do is capture that information. So when we're ready to go figure out what our debt to asset ratio is, we have an idea of what that is. And so as long as it can help us make good decisions about our business, then it's a good accounting system for us. And what does an accounting system do? It actually just accumulates the information in a manner that is useful to the owner and can be readily translated into standardized financial information for outside users. And this paragraph is very, very important. So it accumulates information in a manner that is useful to the owner and can readily be translated into standard financial information for outside users, which is what we just discussed about your financial statements and about your ratios, okay? So you want an accounting system that's going to put all of that together for you. So when you're ready to figure one of those sheets, it's easily accessible. There are computerized accounting systems that do that and do that very well for you. But before you invest in one, be sure to find out what the hardware requirements are. What is the ability to modify those as your business grows? What kind of support services are available? The ability to expand them. So maybe you start very small now and you're one computer operation. But what if you need to expand and you have multiple employees all working at the same time on different computers? How user-friendly is it? Some of them can be very, very complicated, and some are really user-friendly. What kind of training is going to be necessary, and who can provide that training before you feel comfortable on it? What kind of reports and documents can it get? Does it do your invoicing for you? Will it generate an income statement for you? And what kind of personnel requirements are required in order to operate it and keep it operating well? Funny story, a client the other day said that they had hooked up and she needed some support services for a computer program. And she went back to call support, and the support said, well, why don't you just have your IT department address that? And we found that kind of comical, as she is a single owner LLC and her IT department was her and it was out of her control. So those are questions that you want to ask with regards to your account system. So a good accounting system will provide you with enough detailed information about your cost centers and your revenue centers to allow you to analyze the profitability of the segments of your business as well as your business as a whole. So maybe you offer service along with the product that you sell, and you look at the service area and see what kind of income and profitability that's generating versus your tangible hands-on products. Okay, but then together those obviously form the general health of the business as a whole. A good accounting system accumulates the information by budget items so you can readily compare your projections to reality. Again, what did you project in sales? What did you project in service? And a good system does not have to include a big computer and fancy programs. As a matter of fact, some of them are too big for small businesses. There are good accounting systems available for smaller businesses. And even if that means pencil and paper or an Excel spreadsheet on a computer, particularly when you're getting started, that works quite well. But the important thing is that you know the health and the pulse of your business at any given time, and that you are organized in a fashion so when you file your taxes at the end of your business year, you are able to do it and not lose any sleep over it, knowing that you have the best records and the best financial information that you can report to the Internal Revenue Service. Um, so it's quite simple in a nutshell. We don't want to overthink it. We don't want to make it more difficult than it is. And so we said budgeting is very important. So what is budgeting? It's projecting or forecasting into the future. It's asking how much money will be spent and how much money will be received. Hopefully, most of you are accustomed to doing that in your personal households, in your personal financial management. And so taking it into a business is very similar. It's just going out a little different, and your income and expenses will look a little different. And why is it important to budget? Because we're being proactive, not reactive. So we're looking at things before they happen and say, oh, what if? Okay. We know that we don't have a crystal ball. We're not going to see it 100%, and there's going to be some inaccuracies, but it does provide a measurement of your progress. And again, in that planning cycle, we can then look and say, well, what happened that our sales were down this month, this week, this year? And obviously, a very clear example is the pandemic. You know, when businesses were shut down at the beginning of March, bam. I mean, obviously, nobody's budget, nobody was prepared for that. And so, as businesses are starting to reopen, they had to go back and look at their budget and say, realistically, you know, what is going to happen now as we ramp up? Okay, so all it is a forecast. But again, we're being proactive. So we're looking at, will I have enough money to pay that utility bill or my liability insurance or my employees on their next payroll? Okay. And so it helps us to get to know our business, prepares us financially. It fuels creativity because we might be forced to think, wow, what else can I do? And again, I'll use the pandemic. We saw lots of things that changed in the pandemic. People started doing curbside pickup, right? Online orders, telephone orders, everything changed in a heartbeat because they were fueling their creativity to get more income into their business. It also can provide benchmarks. So the first year is clearly the most difficult. But now that we've got, let's say, January, February, March under our belt as an operating business, we can look back and say, January, February, and March, typically we did this. And so are we going to need to ramp up employees? Or are we going to maybe consider cutting back on employees or cutting on our hours of operation? Those kinds of things. And it uncovers bottlenecks to say, oh my goodness, you know, my utilities are due on the 15th, but also most of my suppliers expect to be paid on the 15th. I don't have all that income coming in before the 15th of the month. So is it possible to work with somebody and get those due dates moved a little bit so that it gives you a little more flexibility and feasibility in paying those bills? And it helps identify buying patterns of your clients, and it involves your employees so they can anticipate what their work schedule might be as well. And so sales forecasting can be done in multiple ways. Harry still kind of likes just a good old spreadsheet for his bookkeeping. And so we're going to work with Harry on a quarterly basis. We're going to break it down by the months. And because Harry sells appliances, in January, he predicts he's going to sell about 30 of them. And each price per unit is an average of $300. So his total sales for January are going to come to $9,000 for that one particular dishwasher. Then maybe when he gets into his service product or service number 2, maybe that's just a stove. And so he projects he's going to sell 70 of them. And so his total sales for that is going to be $35,000 in January. And then product number 3, it might be a refrigerator. And he's only going to sell 2 in January because it's not very cold out. People are using their garage to keep their extra things cold. So at $3,000 each, he's going to sell 6,000. So then he adds up all of his product sales in the 3 categories that he's identified, and he comes up with $50,000 for the month of January. He's been around in business for a while, so he proceeds and says, yep, based on February, March, and April, this is typically what happens. And then you'll see as he goes across, he has a quarterly total. And again, his then total sales for his 3 months of operations is $164,000. Then, of course, he knows about what it costs to open his business. So he's also going to look at his expense sheet in a similar way. And again, this is very simplified, but he's going to plug in what his expenses are, figure those out for the quarter, and hopefully he's going to come up with less than $164,000 because that's all the money he's going to have to work with in that quarter. And so what I want to help you with as you design and develop your business plans is to find out what your break-even point is. Remember, one of the questions we ask ourselves before going into business is this feasible to do? Is this profitable? And so we're going to figure out how many do you need to sell before you start making a profit. Okay. And that doesn't mean even that you have to have a tangible product. It could be services. So how many hours of services do you need to deliver? We're talking a product or service. And the way that we figure the break-even point is we look at it by volume. So we take our fixed costs and we're going to subtract our variable costs. So what is the cost of the product and how much does it cost us in order to make that product and sell that product? For an example, let's say the selling price is $10 on the product that we're working with. The cost of goods sold, in other words, how much does each one cost us, whether we're manufacturing it ourselves or purchasing it from a wholesaler, that cost comes to $5.50 per unit. So that means our profit margin on each piece sold is $4.50 per unit. Now, because we've done our projections on our cost, we know that our fixed costs, in other words, our electric and our telephone and our internet, our liability insurance, all of those kinds of things are $1,350 per month. So we're going to take $1,350 of expenses and divide that by $4.50 profit on the items that we sold. And we're going to figure out that we need to sell 300 units per month to break even. In other words, just to pay our bills. Okay. Now, if we want to make any profit off of our business, which of course we all do, that's why we're in business, we will start making a profit when we sell our 301st item in a month. So the break even in dollars of sales is 300 units times $10 means that we have to do $3,000 in sales in a month. So we ask ourselves, is that feasible to do? Can we sustain that? Again, if that's in a riding lawnmower, we can probably sell one a month, right? If that's in the dollar store at $1, we might need a lot higher traffic area in order to achieve that. So when we want to plan for profit, we ask the question, can we sell 300 per month at $10 each? And if it takes 300 a month just to break even, how many more can you sell to make your profit goal? Where are you setting your goal for your profit? So let's say you want to make $900 a month in profit for your own paycheck. It took 300 units just to break even. So after the first 300 sold, now $4.50 contributes to the actual profit of your business. So $900 divided by the $4 that's being contributed to the profit equals 200 units more in sales to profit that $900 for your paycheck. So that's your monthly profit goal. So in addition to the 300 for break even, we now have to sell an additional 200 to make our profit goal. So the question becomes, can you sell 500 units per month to reach your goal? And if not, what can you do about it? How can you change that? And that's what we're going to talk about next week. So with that, again, I'm going to open it up for any questions. Your microphone should all be unmuted. So just make sure your microphone is on if you'd like to ask a question, or you can put it in the chat box where it says Q&A. And again, we will send the recording out to you along with the handout. So if you do have any questions, don't hesitate to reach out to us. We're here for you. We look forward to seeing you next week. We'll be the 5th of our 6th week already. How time flies. So I hope that you're keeping up on those, the business plans, because I really would like to see you get that accomplished as you work through these sessions, okay? So again, don't hesitate to email or call with any questions. We're here to help in any way we can. So with that, I wish you all a good week. Enjoy this beautiful sunshine, and hopefully spring is not far away. So thanks again for joining us. Have a great day. Bye-bye.